Marcus, how's it going?
Never better.
Yeah?
Never better. Yeah.
Listen, it was great to have you here and as part of the Battery team, and congrats again on your promotion to general partner. You feel more responsibility on your shoulders at this point?
For sure. I mean, it's an incredible privilege to work in this firm, but it's also like just a privilege to do this kind of work. I mean, to get to meet all of these incredibly impassioned, brilliant people. Sometimes they're crazy, sometimes they're brilliant and crazy, but they're just the most exhilarating people to interact with founders. I consider them my tribe, and then to get to meet them in the context of being, part of this world-class platform at Battery, it's a dream, really.
Yeah.
So thank you, and thank you to the partnership for including me in the fold.
Yeah, no, absolutely. Look, when I joined the venture business about 10 years ago, kind of had a similar wake-up moment where there's so many engineers like myself. I was a chip designer by training, went to software, and so many of my tribe, if you will, were starting amazing companies like Mongo and Cloudera and AppDynamics. But many of these engineers didn't quite know how to translate their technology capabilities into product and what customers wanted. And so that was my calling to venture, saying, how can I help many of these folks on the product market fit and then help them scale the business? And it's been a very fortunate run. The last 10 years that I've been here, had a chance to witness a handful of companies that have gone from a couple million to a couple of billion, and all the lessons learned along the way. So it's such a rewarding job, obviously with its moments of stress, but
of course,
it's a great place to be and help many founders and look back at all the companies we formed. But what an interesting time to be in the business.
Incredible.
You look at everything around us, and what do you think? Like, what are some of the most notable things you see as quite different than your days as a founder?
There's so much to talk about, but I mean, one of the most striking things, and it was a real change for me in joining Battery and just joining the venture world in general, was just how the balance of power has changed between founder and capital. In my era, which I date to the early 2000s, we used to high five if we could find someone who was 2 degrees of separation from one of these famous Sandhill Road firms. And now I find myself standing in line, waiting to talk to a 26-year-old Stanford CS dropout and get to hear his wisdom. And so, it's an complete inversion in terms of the relative. I guess it's kind of the relative abundance of talent versus capital. And the founder in me is thrilled by the fact that it's so much easier, or there's so much more. Some of the inputs that it takes in order to start a company are so much more available, and there's so much more recognition of kind of the magic, as well as the incredible sacrifice it takes to be a founder. I think I felt often on my journey that was underappreciated.
Yeah.
And we were kind of servants of the VCs. Now I think that's been inverted. At times it's a little exasperating, I must say, in our role. But overall, I think it's a healthy thing for innovation. It's a healthy thing for Silicon Valley. I don't know if you've seen it feel as dramatic in that respect over the last decade.
Yeah, no, look, I think a lot of this is the market circumstances we're in, right? Yeah. So there's certainly a set of characteristics that founders have to exhibit, but the balance of power between founders and VCs, a lot of this is the market circumstances we're in. And I think there's both sides of it, which I think about a lot. On one hand, I've never seen the market opportunity be as big as it is right now. We were stuck in the software era saying, hey, IT is growing 2 to 3% a year.
That's right.
And so it's stuck at like 8 to 900 billion. And then you try to find the best companies within that bounded universe. And for the first time, it feels like, technology and software in general is going to expand possibly from 800 billion to 3 or 4 trillion, partially because you're automating services, but more importantly, you're augmenting human labor. So the most exciting part of the market is the expansion potential, which is massive. As a result of which, you're also seeing an explosion in the amount of innovation and how quickly companies can get some amazing products to market, which is really exciting.
Yeah.
And I look at this and it feels like the best of the cloud world and the dot-com world. In the dot-com world, there was the wow factor. Being able to find a book online on Amazon, as cliche as it sounds now, but like was this wow moment. You didn't have to go to the store, or you could download a movie on Netflix. And so AI has a lot of the wow factor. I look at some of the engagement I have with ChatGPT, and the wow factor is real. But at the same time, unlike .com, there's a real market opportunity. A lot of these wow applications in sales or coding truly have market opportunity, and the market opportunity is even expanding. So it's a great time to be in this massively exploding market where you have the wow factor of the products that people are building, and the combination of the two makes it a really exciting time to be building a company and investing in there. Now, the sheer numbers are scary though.
Yes.
When I joined the venture business, roughly 5,000 companies, and maybe 100 of them would go public at a $2 to $5 billion market cap. And if you're in one of those companies, that was success. I look at it now, and there's probably 15 to 20,000 companies, and there's 30 companies that look like they will be $100 billion franchises, right? So the odds of success are 1 in 1,000 or 1 in 500. But if you find the right one, these are iconic platform companies that are the Google, the NVIDIAs, the Amazons of tomorrow, and they're all being formed. So it's exciting, but it's unnerving in terms of the number of companies we have to process. And even as a founder, it takes a whole different set of discipline to differentiate yourselves in all this noise. So
that's right.
So that's kind of my take on it.
When I talk to founders, I say there's never been a more magical time to be a founder, right? I mean, capital is abundant, talent is competitive, but you have so many more people that are entrepreneurially oriented, and you have so much more guidance. This is embarrassing to say, but in my time, the early founder days, like even the basic financial metrics, what sales efficiency meant, like how you should think about conversion rates in a pipeline, what are SaaS metrics? Like these things were kind of obscure, and you were just kind of feeling your way through them. And now there's just so much more systematic, formalized advice. You have so many more human networks to interact with, so much more guidance, and so many more firms, so many sources of capital that are there thinking we're not just going to finance your business, we're going to actually take an operational or instrumental enabling role to help you succeed. So all of those things are fantastic. But as you point out, when you attract a lot of entrepreneurs, you have more competition.
Yeah.
And the odds have always been long, but I would say to really differentiate yourself, amidst all the opportunity has been just as intense as ever. Maybe in some respects even more so. I wonder how you think about not only the fact that we have a tough underwriting decision to pick who's going to be a winner, but just the kind of scale of the amount of capital that's required that we now think is necessary per winner. Is orders of magnitude more than they were a generation ago or even 10 years ago.
Yeah, look, and it's a very good point you make here, Marcus, because it's such an irony. Because on one hand, I've never seen companies with 10, 20 people get to 10, 20 million in revenue.
Sometimes in a year.
In a year.
It's incredible to go from zero, be in market in January and have a 10 million in ARR by December. It's incredible in a way.
Yeah, look, Marcus, you of most people can talk to, like you built Guidewire from the ground up to a $20 billion franchise. And you're being very humble here, but like that was a long journey to add a ton of value, right? And you contrast that to today. You as a first-time founder can go shrink wrap, workflow around a foundation model, run that on an inference provider, run on NVIDIA GPUs, and you can get to $10 million in revenue with 10 people in a year. Right?
That's what's incredible. The time to MVP is so short. Like the time to get to something that's plausible, that adds value, that has a curb appeal, that's compelling to a business buyer. Just the impedance to get to that as a founder has never been lower, I'm convinced, at any time in technology. That's not the same as saying the time to make a durable venture scale business. That's a different question.
Absolutely.
Right.
But there's two elements of it. There's the durable modes to build a business like Guidewire over the long run. But there's also the capital needs.
Yes.
And that's where it's a head scratcher. While companies can get to 10 million in revenue in less than a year with 10 people, why do they feel compelled to go raise hundreds of millions of dollars?
I worry about this a lot too, Dharmesh. I mean, I think that I understand or I empathize as a former founder in the desire to show indices of progress. And you want to show that to investors, you want to show it to your team, you want to show it to the market, right? And one of the most objective, clear, straightforward ways is look how much capital we've raised and look how much faster we've raised it than our competitors. And so there's a powerful appeal just instrumentally to demonstrating that kind of traction. There is also an egoistic appeal because, face it, even in today's era, you're getting a lot of rejection as a founder. People are turning you down as customers, they're turning you down to join the company, and it's immensely rewarding for once to be courted by investors and then to be told in concrete terms, this is how much we think you're worth, and for that to be a much bigger number than it was 18 months ago. I understand that need, even though it's ultimately not what drives longer term value. What worries me, I think, is that the other side of that equation isn't always appreciated. When you take capital, you are not only adding fuel to your machine, to your engine, but you are also making a promise. You're making a promise and you are signing up to a certain speed at which this treadmill that you're on is going to be running. That belt is going to go faster. And I think that dimension and therefore the kind of pressures and the kind of requirements that imposes on a business, I don't think are fully appreciated. And in an era of relative capital abundance, maybe you can defer that question. And if things go up and to the right indefinitely, the question never arises.
Yeah.
The problem is there's a level of downside risk that's built into that. And as you and I know, when one of those downside scenarios emerges, as it just happens statistically for a large number of companies, then the loftier the valuation, the more painful that reset is. And it comes out in compensation, comes out in investor misalignment, all these other kinds of hidden costs. And so I do worry about that. And it's not just from the perspective of these companies may or may not be valued appropriately, if that idea even makes sense. It is that, that the higher the valuation, the more pressure that you have imposed on your company to deliver against a reality that may not be there.
Yeah.
Right?
Yeah, I know, totally.
Or not there at the pace that you want it to be.
Look, I couldn't agree more. I also wonder, what is it that founders are not thinking about or not telling us as they raise these monumental sums of money? Like one thing which is striking here is the gross margin profile for many of these companies.
Yep.
It's very easy for you, well, not that easy, but like it's easy to go from $0 to $1 billion if you're spending $2 billion to get there.
Of course.
And you have negative gross margins, right? If you, in the dot-com era, when I started my career, I was always like scratching my head saying, why is pets.com selling, a $20 bag of, cat food for $10? That's not a great way to scale the business. And you see a lot of that repeat right now. Like a lot of companies are selling applications at negative gross margins, and they're burning a lot of money. And it's expensive equity to achieve those goals. But I think that defers the return to fundamentals.
Yeah.
Companies need to use that traction to lock in customers, provide more value, and get to software-like margins in the 60-70% range. And if you can get there in 2 years, you may not need $1 billion. If you get there in 5 years and you defer that pain, you're going to need to raise a lot of money. But is that the right thing to do? Should we use customer feedback and customer funding to improve the fundamentals of the business? That's kind of how I grew up and you grew up.
Indeed.
In terms of building an 80% gross margin business, getting it to cash flow positive at 100, 200 million scale, and then generating free cash flow for our investors as public companies.
And that's the tried and true model
here.
Yeah, and look, every venture-backed business is loss-making for a long while. You have to invest in order to build, and everyone understands that. In the traditional software world, we had a model of how that evolves over time, and we understood that software, quality software is extremely intrinsically high gross margin business, and getting to 80-90% gross margins is possible and is natural for a successful software business. What troubles me in the current moment is not so much that you have to invest a long time and sometimes at significant or even escalating losses in order to take share. It's that maybe we don't really know what the long-term deep structural gross margin is, the way that we knew it in the era of SaaS and prior to SaaS. And so I think we don't really know how the full cost of inference, for example, which is such a core input into these AI businesses, what the real number is. I don't think anybody really knows right now. There's a huge data center build out, a multi-trillion-dollar data center build out that we're in the midst of. New models are emerging. They have different kinds of profiles. They take enormous amounts of capital to train. Maybe that gets better. Maybe it gets. Maybe there's diminishing returns. Maybe there are efficiencies. What we don't really know is what is the long-term gross margin of this magical new technology that we see so many uses for. And I think that's a kind of core risk that we can't really solve. We just have to take our best guess. I don't know if you have a more informed opinion on that.
Look, I think coming back to the fundamental opportunity, which is if you're automating human workflows using software, it may perhaps not be possible to achieve 85% gross margins that you had in Gen 1 SaaS. Maybe you are stuck at 60 to 65% gross margins because you're using foundation models and cloud infrastructure to accelerate your development velocity and your product velocity. But it's also feasible. We know through companies like Gong and Unify that sales can be so much more efficient. One salesperson can now do the job of 4 people because they can do prospecting, they can do demos, they know the next best action in the middle of a conversation. And perhaps that's how we reduce the cost of sales and marketing as a percentage of revenue. Most of the developers these days are growing up, with a Cursor or Windsurf IDE. And so that can reduce the cost of development. And so perhaps we never get to 80% gross margins, but we can still get to 30% operating margins by reducing the cost of sales, marketing, and R&D and G&A as well. So there might be a different trajectory.
That's very interesting.
But it's still fundamental quality of the business that you have to focus on. And the more money you raise, because it's so easy to raise money, the more you defer that pain. And ultimately, public companies need to show the quality of revenues to generate value for investors.
And the quality of the unit economics. And I think I think we're all enduring a kind of period of a little bit of suspension of disbelief. We're waiting for that to mature and for us to understand. But you raise a great point, which is I think maybe there's we can recapture a little bit of the inefficiency on the gross margins and the gross profits at the OpEx line. And I think this is some of the most interesting stuff that's happening. If I look at the 6-7 companies in my portfolio at Battery, I see them experimenting in very energetic and innovative ways about all kinds of basic back office processes. They're kind of insisting on efficiencies within their own organization and things that that could potentially take out huge amounts of cost in just the basic operations of a software company. For example, Hyperexponential, one of the companies where we led the Series B, they have a mandate that if you're going to file an issue, with a bug, then you actually have to propose a code fix. So you're not just flagging the issue; you're actually using coding automation in order to predict or propose an alternate resolution for that. Therefore, taking a couple of the steps out in the actual improvement of the issue. And it's early days with those kinds of experiments, but you can see the potential to have like a very significant kind of internal labor takeout that could manifest at the operating expense line. So that's another possibility that's hopeful. But I'd say overall, there's a lot of uncertainty about what the true unit economics is of some of these native businesses. Enormous value creation, but still a little bit unclear in terms of the economics.
When I talk to my friends, my tribe, engineers and product guys that have grown up to be repeat founders, I tell them you can be short-term greedy by raising a lot of capital, ignoring your gross margin issues, doing secondaries for your employees while deferring the fundamentals of the business to a later date. Or you can be long-term greedy and say, let me use my early momentum to expand my product attack surface, build a durable moat, return to respectable gross margins and operating margins and efficiencies.
I'm curious though, Dharmesh, how do you answer the founder that feels like I'm not chasing a high valuation. I don't need huge amounts of capital to run the business. I would like to take a slower, more considered path towards growth, but I feel like I have no choice because this is the market moment is happening now. I have competitor XYZ that's raised so much money. I have to make the case to the talent that I'm trying to recruit that that we're one of the leaders and that we've got the imprimatur of top VCs writing giant checks. I have some thoughts on how you answer those those questions, but I'd love to know what you do these days.
Yeah, look, I'm not suggesting you should grow your business slow and lose market share to competitors, right? I'm just advocating doing that with a focus on fundamentals, right? So if you are in a business where you're going from 1 to 10 to 100 in 2 years, and we are seeing many of those businesses that we've never seen before, you should absolutely focus on acquiring market share and compounding your product velocity and raising the appropriate amount of money that you need to go achieve those objectives. But on the other hand, you can still do this the right way. When you go from 10 to 100 and 100 to 500, you don't have to maintain 0 to negative 10% gross margins. That scale should give you the opportunity to negotiate with hyperscalers and foundation models and chip providers if you desire to buy your own GPUs to get to 60, 65% gross margins. As you scale, you can ramp your sales teams and using some of these newer tools, I mentioned Gong, Unifier, 2 in our portfolio, to improve your magic number to be 1.5x and reduce sales and marketing to 30, 35% of revenue, not 60% of revenue. You can use automation and tools like Cursor and Claude to reduce your R&D to 20, 25% of revenue. So you can grow and acquire market share in a responsible way and raise whatever money is necessary to support those goals. If you keep deferring the pain and 500 million, your negative gross margin, it is going to come back and bite you someday. That is going to go out of vogue. And so it's a return to the quality of the business, not compromise the growth potential for the business.
I try to emphasize similar themes. Often the numbers aren't quite as large in my imagining, but I always emphasize, first of all, recognize whenever you raise capital, you're getting an asset, but you're making a promise. And the question is, how big a promise do you want to make? And how much is that going to burden you in the future? Secondly, you must attend to the unit economics of your company. I had to explain this to my own company when we went public. They said, well, now that we've raised all this capital, surely we can spend it. Surely we can, surely everyone gets a raise. And I said, let me disabuse you of that notion. What we've done now.
You're not very popular, were you?
No, that was a fundamental misunderstanding that I had to correct. But it's very natural to think that if you have more capital, therefore you can spend more. No, you are evaluated on the quality of the economic machine that you are building. You need more capital to keep that machine going, but the quality of that machine is its own question, and that's what you have to create. And then finally, to the point about talent, I said, you should think of it as a screen. That if the only people you can attract, if the people you want to attract need to see these kinds of superficial indicia of success, or they're just attracted to those kinds of qualities, then they are going to be short-timers. There are people there who have not attached to your mission, and they're going to be brittle. Their loyalty is brittle. So think about more enduring ways to create value and to create attraction for the talent that you want, other than just a sticker price on how much you've been able to raise.
Yeah, Marcus, I do wonder, as I hear you talk, we had the benefit of learning through these incredible kind of curves of .com growth and cloud growth, which many of the founders in the AI era may not have had. I think the AI founder persona is quite different than what we used to see in the cloud era, perhaps closer to the .com era. Most of the AI founders I see are first-timers. They grew up in the post-chat GPT era. They've had 3 to 4 years of work experience. They have only seen this hyper-growth and abundance of capital. So it's very hard for us to draw parallels to what could go wrong or how they should focus on the fundamentals of the business, because they can't relate to it. But on the other hand, this lack of being encumbered by legacy is also the reason why they have such a fresh perspective and they're able to grow at this pace, right? So there are humans at the end who haven't seen the last couple of waves and how they ended. And so I wonder, how do you feel this new category of AI founders? Do you feel the same way?
I feel that it's amazing. It's what's exhilarating about this job. Actually, I'll meet young founders sometimes, and they will describe their ambition, and sometimes completely without irony, they will say, we're going to completely transform this multi-trillion-dollar industry. That's phase 3. Phase 2, we're going to become the most profitable. We're going to be a multi-billion-dollar software company. We're still in phase 1, but they have some astronomical ambition. And I'm bemused sometimes as I hear these ambitions, but at the other side, I'm moved. I love the fact that you have founders who feel like, I have the inputs, I have the vision, I have the enabling technology to do things at this kind of scale. And frankly, if anything, they're more ambitious than founders of my generation or perhaps of yours. And when we say generation, we're just talking about 20 years. It's well within the span of one career. So that's great to see that. I think, though, that, and I know that we both look for this when we talk to founders, you want a balance. It has to be balanced. And the most rewarding founders that I find to interact with are ones that have essentially an unbounded vision on what they can achieve, but they have a sense of the waypoints that they have to get through in order to unlock that. And they're pragmatic and grounded about what's the minimum that I need in capital, in talent, in time, in order to get to waypoint 1, and that unlocks my chance at waypoint 2. And they have a plan of attack. It's not just intergalactic destiny. It's I have to achieve this in order to earn my right into the next one. What's different, I think, to your point, is that maybe because there's a sense of we live in an era of some extraordinary multi-trillion-dollar successes, and even that seems like a science fiction number. I think there's a sense that there really is. It's really unbounded what you could build, right? And I think that's enormously exciting. I also think it's exciting that the categories of change and positive improvement, it's a much wider field of possibility. It's not just, well, you can change some workflow, you can capture some better data, you can build a little bit more responsive a financial system. It's that, no, we can completely imagine entire categories of human activity, in physical security, in manufacturing, in all the white-collar work that's being done right now. We can reimagine each of those from first principles, imagining what we have with this new enabling technologies. And it's not just LLMs, it's also video AI, it's voice AI, and it's superior integration technology, it's new kinds of infinitely scalable cloud architectures and in compute capacity. That all these inputs now, I think, have just blown open the field of the imaginable. And that makes it, again, enormously exciting time to be both an entrepreneur and an investor.
No, it is. I mean, I love the fact that this new class of founders are not held back by legacy. They're like, well, it's only possible to grow software by like 50%. How can you go beyond that? You've never seen that, right? So I love the fact that you're not encumbered by legacy. And I saw many of the same characteristics. I graduated in the late 90s, started working just on the cusp of the .com boom followed by the bust. But this reminds me a lot. Like when we were growing up, we weren't bounded by client-server architectures. Like, well, everything is going to be globally available on the internet.
Yes.
And so you can do commerce on the internet. You can distribute movies on the internet. You can search on the internet. And that imagination is what led to, Google and Netflix and NVIDIA kind of creating multi-trillion-dollar franchises, right? I see a repeat of that same thing here. But I also look for founders who are aware that they have to balance their unbounded enthusiasm and ambition with lessons as they scale, right? So I don't know what your experience has been, but like many of the conversations I have with Series A, Series B companies that are growing from 1 to 10 to 50 or 100 sometimes is, hey, this is great, but I'm really paranoid. What am I not seeing? I want to be paranoid, but flexible to adjust, because every time I succeed, I know there's 5 other companies that are shrink wrapping their software around some foundation model and coming very quickly after me, right? So how do I stay ahead? How do I continue to grow my market share? And then how do I continue to scale the business, hire the right people?
I think you're speaking to something that I believe as a firm we need to take very seriously, which are like, what are the kind of cultural character traits in the founders that really set them up for the success on this long and variable journey to build something out of nothing? And you alluded to a number of those things that I really look for in these conversations, which are, you have ambition, but do you have self-awareness, right? Do you have a learning, and like, are you insatiably curious, right? Do you accept advice, including from me or from other people who've built their own companies or seen a lot of companies? Do you accept that uncritically, or are you constantly questioning at a level of first principles to satisfy yourself in a rigorous way that this is coherent and this makes sense today? And when you have that kind of mixture of qualities where you have humility and self-awareness combined with ambition and curiosity, you have the makings of a founder that can really build something great. To your point about what are they asking, what are they seeking? I think it's so different. It's really interesting to reflect on how different it is from the kind of questions that I worried about in the early days. The main thing I worried about is, are we going to run out of money and will it be game over? All right. I think you hear them saying they just assume that if the company's achieving market traction, capital will take care of itself. The terror that was such a big part of my early years as a founder, I think, is generally absent from the founders that I talk to. And maybe that reflects growing up in a time of abundance, like our kids. But I see them much more paranoid about talent and saying, how do I make this a compelling place where the superstar talent that I need is going to make the difference? Of course, every founder thinks about talent. I thought about it all the time, but I did not have such an acute sense that if I'm not getting the very best and the brightest right now on this frontier of technology, we're going to lose. I didn't have that particular paranoia, but I see that all the time in the founders we interact with now. And I think there's a worry about, how do I cut through the noise in the market? There's so many other entrants. There's a new crop. There's a new of YC founders coming out every few months. How in this very crowded, kind of tech-frenzied moment do I get people to pay attention to me and leave my mark? And those are the questions that you have during a boom time, which we're in. How long it lasts, people can have different opinions, but those are the characteristic anxieties, I think, of the moment.
What about the talent side? Do you have a point of view on how much should a founder freak out if they can't hire those 20 core engineers in a world where code can be automated to a large degree? Like, where on the spectrum are you in terms of their paranoia around talent?
I don't know. At least for the most of the founders I'm interacting with, they think these coding tools are great. They're enablers, but I don't think any of them believe that the core spark, like the distinctive specialness of their company, can be outsourced to a digital agent. They feel like they still, rightly or wrongly, I think rightly, believe that you need you need like distinctly talented engineers and product designers, and as you know, the war for that talent is probably the most intense that I've seen in my career. I don't know if you feel similarly.
Yeah, no, I mean, I saw some of that in the cloud era. If you were a distributed systems engineer with experience at Google or Facebook or LinkedIn, and then prior to that, you spent time at Oracle, there was a tremendous amount of demand for that set of talent. So it keeps moving. It's there. On one hand, there's an enormous kind of demand for talent. On the other hand, there's so much more productivity tools. And I do wonder, like, if you as a company can achieve so much with, tens of people, do you really get this false sense of security that you have all these talents and so you should succeed? It's kind of the same as like having capital is not going to make you succeed.
No.
that will reduce the chances of failing, but just raising a lot of money, just like hiring a lot of star engineers, is not going to make you succeed. And this day and age, value in building software comes from the end customer problems you're solving. And so being very pointed on what pain point am I solving, how am I expanding that value offering. And I don't necessarily feel that it's tied directly to how much capital you raise or how many star engineers you have or how many salespeople you have. It really comes down to like the right balance of the right number of people in the right areas, both in go-to-market and sales and marketing, and then constantly iterating through that. Most of the discussions I have with my founders, they generally fall in 3 buckets once we get past the fundraising and the engineering talent discussion, right? One is like how quickly do they need to expand the product velocity, right? Because in Gen 1 SaaS or 10 years ago when Siebel was going to Salesforce or PeopleSoft was going to Workday, you usually could get to the first 100 million with your first product and then launch the second product just as you were filing your S1. In this day and age, by the time you launch your first product, there's 100 YC startups that are replicating you. And so you got to constantly compound your product velocity much early in the cycle. And also if you're augmenting human workflows, 1 + 1 is way more than 2. We have this company, Jump Advisor, that's being used by 10,000 financial advisors just in the course of a year. And they've almost 20x their revenue by providing note-taking and capturing conversations that you may have with your financial advisor. But it's very logical for them to then go automatically fill a W-9 or fill, a 529 form for your kids' education, or to provide insight on market guidance and whether you should invest in bonds or stocks. And so they find this need to compound their product velocity and expand to more and more workflows that a financial advisor does. And that's what keeps them ahead of the market. The second discussion most founders are having is saying, hey, workflows are not going to give you a moat. How do we build a more durable moat so somebody cannot replace my workflow with a better workflow? And so the more you compound your workflows, the more proprietary data you have, which helps you build a proprietary system of record perhaps, right? And the third discussion we have is, look, engineers want to build product, but they still need somebody to sell the product. And so great founders realize that past their first 5-10 million, they have to build a go-to-market team that can scale you to 100 and 500. That's the conversation which I find very mature and very refreshing, which balances their unbounded enthusiasm with the fundamentals of building a good business.
I think you're pointing to the fact that the maturation cycle is significantly faster. The clock speed that a company goes through in understanding its own strategy is significantly faster in this era than in ours. The initial product build for my company was arguably 4 or 5 years. And we had the requirements right, and then we were just building that product, right? And the idea that the next product was going to be released in a year would have been nonsensical. No, it's another 4 or 5 year build in order to understand those requirements. However, I want to key off one other thing you said that reflects a deep opinion I have, and I think that we have, broadly speaking, in the venture team at Battery, which is it's important to own a system of record. The great businesses are built on high revenue quality. Revenue quality means that you have durable, strategic, growing relationships with your customers, and that usually means owning a system. You can do things by facilitating other kinds of work. You can do maybe with some labor displacement, but ultimately, and this may be old school thinking, but I'm still very attached to it, and I think to some degree you are as well. Like to own that system and to be instrumental to some core workflow. In the old days, that meant that you had to have an opinionated data model that other people had to define their own systems and integrations to. But I think that I don't think that AI, for all its magical powers, has changed that deep truth. And if anything, AI offers another conduit, perhaps another vector of approach to provide that new system of record. But I encourage every company that I'm involved with to think, what ultimately do you own? What corpus of information and core process belongs to you as a result of this chapter of the company's growth? And I think that's indispensable.
Yeah, absolutely. And the sooner you focus on that, the more durable your moats are, and the more your business fundamentals will improve towards the realization of potentially an iconic company in the long run. We spend a lot of time talking about application companies.
Yes.
This might perhaps be different for infrastructure because as Battery, we invest up and down the stack, both on application and infrastructure, software primarily. On the infrastructure side, I think it's less important necessarily to build a system of record or the workflows.
Yes.
At the infrastructure side, what I'm finding value add is really providing quick time to value to the application companies. Historically, the hyperscalers, of Amazon, Google, Microsoft were part of large companies. They had the capital advantage and the ability to support hundreds of customers by, letting them spin up the applications in months and years. What I'm seeing over the last, 3 to 5 years is hyperscalers are so busy supporting their existing customers that make up their 300-400 billion in revenue. There's this whole class of YC startups and application companies that have very different needs for GPU scaling and networking scaling.
And AI middleware. Yeah.
AI middleware, right?
Yeah.
So that whole layer of AI middleware is presenting another monumental opportunity. It feels like companies like both Databricks and Snowflake, as well as some of the upstarts like Base 10 and Fireworks and Together, are really going after the hyperscaler layer and possibly building something where you can abstract the complexity of building an AI application without necessarily paying the 60-70% margins you have to pay to Amazon, and doing this in a very AI native way. And so for those kind of companies, an intimate understanding of GPU hardware, both from AMD, NVIDIA, new hardware on the networking and storage side, as well as an awareness of the application layer, is instrumental to build the next AWS, the next GCP, the next Azure. And there's some iconic companies that are being formed in that market.
Do you believe that'll be additive to the existing hyperscalers, or it will create its own alternate universe that coexist with it? Do you think that the existing hyperscalers are going to adapt and either adapt or acquire their way into it? How do you see that evolving?
Yeah, I think the price is too high, too large for hyperscalers to not pay advantage. But again, they balance between supporting their existing $500 billion revenue stream from enterprise and legacy customers with providing enough of a product roadmap to the new scale of upstarts. So look, I'm only speculating here, but I would not be surprised if a couple of these smaller companies are acquired by hyperscalers as a way to satisfy the Gen AI native segment of software startups. Running a workload on Snowflake or Databricks, do you really know what's supporting that behind the scenes? They don't have their own data center. They're running on the cloud. But for all practical purposes, they're the hyperscaler. When you're running your training or inferencing workload on Base 10 or Together AI, you don't really know what GPU they're using. So I think there's a couple of potential companies that could really expand here. But I'm sure cloud hyperscalers are going to go acquire their way into it.
But do you think that cloud infra providers will face some kind of innovator's dilemma in this AI era, or do you think that it's kind of organic for them to expand? Or do you think that you're alluding to some actual tensions? And I think the question comes up at the application layer, which of course where I spend almost all my time. And there's an anxiety, I think, from existing application companies that there's going to be some innovator dilemma, that they will be impaired in their ability to thrive in an AI world. I'm of the view, and it's my own personal opinion, that's actually not the case. That if you have a coherent strategy, you understand what the customer wants, that the incumbents are just as well situated as new entrants in order. But that it may be a different story.
I might beg to disagree here. It feels like a repeat, of the transition from .com to the cloud era. You had companies like Rackspace and HP Cloud and IBM Cloud that used to support the Gen 1 of software companies.
Right.
And then when they moved to cloud, Amazon, Google, Microsoft had invented kind of this concept of kind of scaling out as opposed to scaling up, which was fundamentally different, right?
Yeah.
You now look at this new class of applications. GPUs are processing multiple cores in parallel. It's very compute intensive on the training side. It might be networking intensive on the inferencing side. And these workloads are so different that it's very difficult for a traditional hyperscaler to adapt to a Gen AI native set of companies. And frankly, from an economics perspective, if I'm Google sitting at a $3 trillion market cap, I'm more worried about NVIDIA eating my margins, which is why they're building TPUs to compete with NVIDIA on the hardware layer. You're seeing Amazon push training and inferentia to compete with NVIDIA on the chip layer, and possibly on the networking layer with Cisco and Arista. So the prize is much larger for a $3 trillion company to go after a $4 trillion incumbent, as opposed to worrying about a $500 million hyperscaler that's supporting cloud native.
Right.
Now, when they wake up, it is possible technically to get there, but then there's a go-to-market advantage. If I'm GCP or Azure, am I better off buying one of these, Gen AI hyperscalers, or am I better off building that from scratch? So that will play out in the next couple of years. A lot of that depends upon the enterprise demand for Gen AI. If there's this massive pent-up demand for hundreds of billions in AI workflows, then I think the hyperscalers are going to acquire their way through it. If it's a more gradual rollout, then I think they have time to go build it out. But that, I think, is the biggest prize in the software and the IT stack. Who's going to go build a $1 trillion hyperscaler for Gen AI companies? And then there's going to be all these middleware companies that are building the next generation of security or observability or compliance or what have you, that are also creating value in the tens of billions of dollars. So it's a really exciting time to be in the infrastructure space, albeit with a different playbook for founders.
I love your take on the question that you just teed up, which is the enterprise demand for AI.
Yeah.
Something that we debate a lot in the partnership about the trajectory. No one knows the future for sure. Obviously, there's a kind of contrarian theme that's now in the conversation, which is that enterprises are much slower to adopt this than was optimistically assumed, let's say 18, 24 months ago. We all see a certain inevitability in that adoption because the value, at least in certain use cases, is just too great for it not to be adopted. But there has been more impedance than maybe was than people thought at some point. What's your latest take on it? And I can share my own view.
Yeah, look, I think AI startups, especially application startups, rightfully so, are much more optimistic than what I hear enterprises, right? I was talking to the head of engineering for a top 5 bank in the US and saying, like, how much code automation are you using? Given the billions that are being generated by Anthropic and Cursor on code automation, what's your spend? And I would have expected the answer to be hundreds of millions for a group of 8,000 engineers.
But it was
they were spending
tens
10
of
million.
Tens of millions, yeah.
Or
single digit millions.
10 million, right? We look at, the adoption of use cases across customer support, where, you don't see companies with big brands necessarily putting an AI bot to answer consumer-centric queries unless it's a routine query. So part of me feels like there's a ton of uptake of AI from other AI startups. It's kind of like the YC crew feeding each other. But the change management needed to get to enterprise might be 1 to 2 years longer than we expect. Eventually, I think this cycle is going to create a ton of value. But the path to get there might involve some fits and starts along the way, especially with enterprise AI adoption, right? Now, in the meantime, we're building $3 trillion worth of data center capacity to unleash the value of these AI applications, right? So again, if I'm an AI software company, there might be abundant data center and GPU supply, perhaps, if enterprise demand is slower. On the other hand, if enterprise demand is what everybody, the best case scenario, then we'll just have to continue building more data center space. So I don't think there's a downside, but there's definitely some fits and starts along the way. I am concerned about the enterprise uptake of AI applications, but I think that just creates more value for software companies who can consume that excess capacity and possibly improve their gross margins in doing so.
Yep. I think that there was definitely over-exuberance, but that happens in every wave of technology.
Yes.
That's like we can't help ourselves as a species. We get excited. We assume that it'll be frictionless, and it's always a bit harder than that. So that's definitely been the case in enterprise. I think that some AI capabilities have not. Well, there was a moment of time, let's just say, a year or a year and a half ago, where we thought scaling is all that you need, and the progress from GPT-3 to 4 was so extraordinary, was so mind-blowing that we thought we just extrapolate this and we're going to blast off to the singularity, within the decade. And I think we now understand. Look, trees don't grow to the sky. This may asymptote at a lower level, or it may be a slower journey. And so now I think it's rational to ask which capabilities are ready for prime time and can be applied, and which ones may still take a lot longer. And so I think there's some disappointment around reasoning. I think that agentic capabilities are fine in principle, but then are now encountering a lot of the kind of IT, let's call it enterprise IT friction that it takes to make systems talk to each other and behave the way you want. And I think there was some overestimation of how quickly certain enterprises would be willing to entrust really economically consequential decisions to systems that still hallucinate, still behave non-deterministically, et cetera. And so there's still a lot of maturation to happen. And it's a question of how. There's no question that there will be enormous progress. The trajectory of that progress, I think, is still somewhat an open question. And I think you point out something very interesting, that if there's disappointment on that could be long-term upside.
Yeah.
Because now you have maybe arguably a little bit of an overbuild, but that can be employed by the next generation of founders tackling the problems. But it's never a linear journey.
Yeah, totally. Look, I think whether it takes 3 years or 5 years, maybe 7 years, there's no doubt in my mind that this market is going to create more value than we have seen in the .com and the cloud era combined. companies are going to benefit from all the advances we're making in reasoning capabilities and human automation. And startups that drive the front end of that change are going to unlock hundreds of billions in value, as we're already seeing. And that's why I think it's super exciting to be in the venture business. We're not trying to time markets and figure out if there's a correction in 6 months or 9 months. If the shape of this curve is up and to the right in the next 5 years, which is kind of what we're expecting, I think all the participants who are on the front end and focusing on the fundamentals of the business will do just fine. And that's the reason why, our doors are open. We successfully deployed capital across several companies with founders who have unbounded ambition, but at the same time balance it out with rational company building and focus on fundamentals. And we're looking forward to more of those opportunities the next couple of years. It's a super exciting time to be in this space, and I'm really, really happy that you're here along with us to be part of the journey.
I share all that all that enthusiasm and all that appreciation. I will say in parting that one of the things that really drew me to Battery and to join this partnership versus others was it's a firm that has been through multiple cycles of technology, and it brings a certain, let's just say, a certain circumspection, a certain wisdom to what the highs and lows look like, and has the fact that the kind of consistency of outcome and delivery by this firm over multiple generations of investors, multiple iterations of the partnership through multiple eras of technology, I think is fairly rare, and it was certainly what compelled me to join, and it's a great privilege to be part of the team.
Yeah, well, we feel the same way here, Marcus. So thanks again for this amazing conversation.